Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stocks for Breakfast. It is Tuesday morning. I want to talk today about risk and specifically how risk and how you handle risk, both from a dollar amount perspective and from a mental perspective. If it's done properly, it actually makes trading a lot easier, which is kind of ironic because so many people are afraid of losing money, and that puts this grip on them where you hesitate to get into a new trade because you're afraid to lose money. You take your profits too quickly because you're afraid to give back those profits, which is kind of the same thing as losing paper profits, right? So today we're going to talk about a very simple way that has worked for me. And when I had my trading firm over the years, it's a process that's super simple. It's a very simple calculation. And most people are usually ask, how do I know how many shares to trade? And that's actually a good question because, quite frankly, most people have zero idea and just trade 1,000 shares on everything, or they pick some random number. And what I'm about to show you is a incredibly easy way to do it, so that before you even put the trade on, okay, I'm okay with putting that money at risk, and if it happens to not work out, I'm okay because that's a part of running my business. Remember, if you're a regular viewer of the channel, if you're a subscriber to the channel, which, by the way, please click down and subscribe if you find these videos helpful, and definitely leave a comment below the channel if you've had some success with something we're teaching. If you want to really take it deep, learn about the boot camp. Click down and I'm a little tired. We had our boot camp coaching call last night. So what we're going to discuss today is the fact that most people who trade, and I'm not going to say amateur versus pro because everybody has this problem at some point in their trading career, is that you put on a trade because you want to make money. You put on a trade because you think your strategy is going to work, and you only look at the profit target. You're only looking in one direction, and then if and when a trade moves against you, you kind of freeze. And then it becomes, gosh, I really hope this trade comes back, and you start to really you kind of get locked up and you can't make a decision. First of all, we teach in the boot camp that you want to make sure that if a trade moves against you, you have a plan for what you're going to do. And what we generally call that is you scale out or you get out. When I scale out, not necessarily get out, because scaling out means you might have just had like this one candle on a daily chart, or if you happen to be swing trading, one candle on an intraday candle that boom goes down, wipes you out, and then not too long after that, it moves again in your favor, and you're like, what happened? I got out, but they keep moving. So scaling out means you're pulling the plug on some of it, and you have a little bit of it still in your position summary so that you can watch it, and then if it moves back up to your original price, you can get back in. Especially in this day of zero commissions, there's no reason not to do that. So you're lowering your exposure when it's not moving in your favor, and then you learn to add to it while it's in your favor. So we're actually going to head over to a very quick PowerPoint. It's only 3 slides, but there's a lot of good stuff on here. But here's the main thing before we actually get into it. Risk is a part of what we do. You're never going to be able to completely avoid trading losses. Here's the way we walk everybody through it in the boot camp, and it makes trading so much easier. You have to see that running your business is no different than running any other business. Trading is a business, and a part of the expenses to run that business, no different than paying the lights or having inventory or having employees or anything like that. A trading loss is an expense that comes with running that business. So you learn to control your expenses, and then you learn how, the longer you're in business, the more you learn about how to make money for that business. And trading is the same thing. So today we're going to walk through a very simple process, both for new traders. I'm going to help give you a calculation on how to figure out the exact amount of shares. And it doesn't matter the volatility of the stock, because the volatility and the stop loss from your entry price will give you the correct number. So we're going to hop over to this presentation. And again, click down, subscribe if you find this helpful, and definitely leave a comment if we helped you do something. So accepting risk. I've used that word very importantly here because most people don't accept risk. Most people take risk. They put a trade on, they take risk, and then if it moves against them, if they weren't prepared for it, they kind of freeze up. So the key to flawlessly trading your system without hesitation is accepting the risk before the trade. Now, before the trade is a big part here. Remember what I said about if you own a business, this is like having inventory. Your inventory is the dollar amount you have to spend as part of running that business in exchange for making money. So that means a specific dollar amount you're comfortable risking. So this is the most important part here. Now, if you could think about, let's say you own like back in the day when my family owned a deli, we had to choose how much roast beef we had to buy for the coming week. So we had to choose a specific inventory, a specific amount that we needed to spend on roast beef. In trading, you need to understand the same thing. You need to choose a dollar amount that you're comfortable risking, and that dollar amount should make sense based on your experience. So do you have a track record of making money, or have you never made money before? Did you start trading yesterday? Did you start trading 3 months ago? Did you start trading 5 years ago? What is your risk tolerance? Are you nervous Nancy, or are you risky Ricky? You have to put that into the equation as well. And neither one of them is right, but here's a key. You need to fully understand that your risk amount has to match your personality. It has to match the way you view things, because if it doesn't, you'll constantly be fighting the system. Also based on how much capital you have in your account and the market conditions. This last one's an interesting one, because quite frankly, some trade ideas are just better than others. And if you're a part of the boot camp, if you're a part of what we do every day, market conditions change minute by minute, day by day. And what we call is the story has changed, the tape has changed. And you need to be able to adjust how you're attacking that market, how you're allocating capital to that market, quite frankly, based on whether or not it's a great idea or if it's not a great idea. Certain situations, you'll work the order. Certain situations, you're like, oh, let's go get them. Everything's lining up. So all of those go into the calculation of accepting risk. So what we're going to give you now is a very simple, easy method. And this is, look, this could change for everybody. You might risk a much higher percentage. You might risk a much lower percentage. Completely up to you. Swing trading versus day trading is a different number. This is the one that I used to start people out of my prop firm and my trading firm in New York City. It was a general calculation where somebody was trading and they felt we gave them a comfortable way to be trading the right amount of shares. So that's the biggest question. The biggest question is, how many shares do I trade, and how do I adjust that share size based on the volatility of the stock? So you could be trading a $500 stock or $30 stock. What matters is what we're going to talk about now, which is the dollar amount. So what we're going to do now, and again, this is just an illustration. You could adjust this up or down based on your own particular circumstances. You're going to take 2% of your equity balance. So that's, if you can imagine, 2% of your cash. Divide that by your entry price minus your stop loss point. So it's the difference between where you got in and your stop loss. That's the simplest way to put that there. So for example, let's say you have $15,000 in your account and you multiply that by 2%. So that's the dollar amount that you're comfortable risking. So remember we said on the previous slide, what's a comfortable dollar amount? And in this case here, we're saying it's 2% of the $15,000. Now we're going to take that $300 and determine what is the right share size based on the volatility of that stock. So just for argument's sake, let's say your entry price is $30 and your stop loss is $29.25. That's a 75-cent difference between where you got it, where you're getting in, and where you plan to get out if the trade moves against you. So what you do is you divide the dollar amount that you're okay with risking by 75 cents in this case, and that tells you for this particular position, you could trade 400 shares and let the trade do what it's going to do comfortably, because prior to putting the trade on, you say, okay, I'm okay with risking 2%. Right now, if 2% means $300 and my stop loss is 75 cents, in this case, it would be 400 shares for this position. Super simple technique. What's interesting and exciting about this too is as your account grows, it's still that same 2%. So you might risk more because your account's growing and then your share size changes, which gives you more opportunity per trade to make more money because you have more share size and you can handle bigger pictures. What's also exciting about this is the $300 in this case, we just happen to use a $30 stock. You could use a $500 stock and have the same calculation where if the stop loss is $2 away, you would use 300 divided by 2, and then that would end up being a different number, which would be 150 shares. So the volatility on the stock doesn't matter in the calculation. It will just tell you to trade less shares if it's a more volatile stock. Something that experienced traders do, something like myself, is we're not necessarily using an exact number anymore. And here's why, before I get backlash on this, is because we have a track record. If you have a track record, you now know how much your business normally earns. So when you know how much your business normally earns, you could take on different expenses. Again, just think about if you happen to have an office and decide when you want to double your office space. Well, you won't know how to do that properly or be able to make a good decision until your business actually makes money. If your company is expanding, if your business is expanding, now if you want, you can start to use the average dollar profit per trade. As you gain experience and a track record, you'll have a better idea of how much you usually earn on winning trades on average. When you reach this level of experience, you reach a certain amount based on your average profit per trade. Now, you don't risk the entire profit per trade, but what I'm getting across here is you will adjust how much you're willing to risk per trade based on the quality of the idea and your track record of how much you typically earn. Most professional traders are willing to risk on a trade what they feel they can earn relative to their history. Now, again, that's not dollar for dollar. It's you now are starting to use your experience to determine how much to risk per trade. That's a different level. And when I say experience, I'm not talking about you made money 2 days this week. I'm talking about 3 months, 6 months, a year of consistent profitability. Okay, and you might choose not to do this. This is another way of determining it. And what's kind of ironic is I need to go through these different scenarios because once I give a calculation, then everybody's like, but what about this? But what about this? But what about this? So I try and answer those questions as best as I can before they get asked. So after trading several months, several years, you should calculate your average cost to trade, including software, losses, subscriptions, and all of those things. So you know to the dime what it costs you to run your trading business. Quarterly is usually a good reference. So what's kind of interesting about this, and before we continue, I'm just going to go back to that. Think about what we just talked about. Now we're talking about including all of your expenses in the calculation of what are your expenses per quarter, what you normally have for your trading losses per month or per quarter. And that's, again, that's real P&L. That's coming out of your real profit and loss statement. What you have in software fees and everything else, internet, all that stuff that is a part of your trading business. Now you have your expenses, and when you get into your expenses versus your profits, now all of a sudden you're running a real business, which makes it kind of fun because now you're no longer just banging keys or buying on Monday and getting out on Thursday. You're actually running a business, which is kind of fun. So we're going to get into the last slide here just to really bring this point home. All right, and now successful money management. Starts with knowing your probabilities inside and out. So this is, of course, assuming that you have an edge, and obviously my edge is order flow and reading the tape. It's more than simply calculating the risk. You have to have a high expectation that you're actually going to make money, right? You must accept the fact that some trades simply have a higher edge of making money and then earn more on those ideas. So this gets back to what I talk about when tape reading, and everybody in the boot camp is really starting to learn this, that some trades just are simple certain situations. And when those situations line up, it's imperative that you earn more on great ideas and then just kind of go back and forth and manage risk and leverage on the ideas that aren't really producing bigger profits or smaller profits, quite honestly. Professional traders know when the odds are in their favor and allocate more when the odds get better. This is kind of, we talked about this yesterday in the boot camp as well, where we discussed every trade you put on you have to think of it like a deal. Like I'm going to put on a deal in Apple today. I'm going to put a deal on in Microsoft today. Some deals are better than others. Some of them, you might be looking at a great house in a great neighborhood that's not cheap, but you love the house. That might be a good deal. And maybe you'll just day trade that stock because there's not a lot of long-term profit potential in that stock. But then you might find a really good neighborhood with a house that needs a little bit of fix up. And if you do what you're supposed to, that has a lot more potential down the road. And that's a little bit different deal. So you might work that order a little bit for the longer term profit potential. So you need to really understand when the odds are better, when the deal is better, when the trade idea is better, when there's more profit potential in the trade. And that's going to distinguish between how long you're going to hold it. So if you're going to hold the trade for a day versus hold the trade for 3 weeks, 3 weeks, you could work the order a little bit and not add to the position until it moves in your favor. If you're holding it for a very short period of time, and it's still a good idea, you might get in with a little more shares and then look to get out quickly as soon as momentum moves in your favor. So identifying these conditions in your strategy is a must goal before you decide the risk amount that you're willing to put in harm's way in the market. And again, this is tape reading. This is building an argument. Is the circumstance still great? Has the circumstances changed? Probably the single biggest thing, the single biggest revelation I think that new people in the boot camp and especially people in the boot camp who have been there for a while, is number one, narrow your focus, and number two, pay attention. Narrowing your focus a lot makes paying attention easier because now you're just focused on certain things. And now you could really start to make those distinctions between, wow, right now is really tough in the stocks I'm trading, I'm going to do nothing, instead of just feeling like, oh, I have to do something, I have to do something, I have to do something. No longer do you have that feeling. You're like, oh, no, I know what I'm looking for, and until I see it, there's nothing to do. And that's really where profitability comes in. And last but not least, if the odds are not good, you should not risk the same amount if you should risk anything at all. And that's a really, really big part of trading, is understanding and learning how to stay away from those low probability ideas, and then really taking the next step and flawlessly never hesitating in your strategy and allowing the odds of your edge to do the hard work, which kind of makes trading easier at that point, because now you're not stressed out about this trade has to make money, this trade has to make money. That's not real trading. That's stressful trading. That's amateur trading. Real trading is see the edge, put it on, see the edge, put it on, see the edge, manage the trade, see the edge, manage the trade. It's not stressful at that point. You're adding shares as it moves in your favor if it warrants it. You're scaling out of some shares if it happens to move against you. And you might eventually get out of the whole thing if you decide the trade's just not working out. But that's where trading is so much more easy. It's so much less stressful because you're not forcing the market to do something. You say, okay, this is probably going to happen. Let's allocate this many shares to the trade. If it starts moving in your favor, now you have profit-taking scenarios, which we discussed yesterday. And then on top of that, you also have scenarios of whether or not you want to scale out of the position or get out of it altogether. So some easy decisions to make if you make those in your trading plan prior to actually putting on the trade in the first place. So hope this helped. If you stayed to the end and this is really stuff that you love watching, definitely click down and learn about the boot camp and see how other traders are doing. I think that you'll be pretty excited to see how simple this actually can be. Have a great day, everybody.